What's going on? We will start out talking about ExxonMobil, ticker symbol XOM. Bad quarter all around for both ExxonMobil and Chevron, but improvements over the last second quarter. GAAP loss per share was 15 cents, but that beat expectations of negative 75 cents. Upstream, downstream, chemical. This is why I keep saying they are resilient. Both Exxon and Chevron, they are fully integrated. They are not just drill and sell company. They have upstream, drilling, downstream, manufacture, and they also are in the chemicals business. Darren Woods, we remain confident in our long-term strategy and the fundamentals of our business and are taking the necessary actions to preserve value while protecting the balance sheet and dividend. We are on pace to achieve our 2020 cost reduction targets and are progressing additional savings next year as we manage through this unprecedented down cycle. Dividend they are working to preserve, which is what I am going for as a dividend growth investor. There was a big drop off from Q1 to Q2, but things have ticked up just a little bit in the liquids and gas, as well as in the petroleum product sales and the chemical. All three have ticked up from Q2 to Q3. Obviously, everything is all down the upstream, downstream, and chemical. You can see that the upstream does make the bulk of their business, 67%. That does hurt, shutting down all those wells. Downstream only 18% and chemical 13% for a total of $4.13 billion for a loss of 46% from the last quarter. Trading at 1.9% below their estimate of their fair value. They expect earnings to grow 57%, as do most people. As soon as we find a vaccine, things are going to explode and get back to normal. There's 8 days left from today, November 1st, to get in on the ex-dividend date of November 9th. Their dividend is obviously obscenely high right now at 10.7%. These two numbers are just horrible. 207% current payout to the shareholders, but it is going to improve by 2023 to 114%. We're going to hope for something a little bit better than that. It's a race against the clock to see if they can get this vaccine going before they have to cut or suspend a dividend. So Exxon did have a third quarterly straight loss of $680 million. The shares were down 1% to $32.62 as of October 30th, 2020. They're cutting spending aggressively and they're reducing spending plans in the coming year, trying to cut costs and be a little bit meaner and leaner. They're going to cut their workforce by about 15%. And they kept the fourth quarter dividend at 87 cents, and this is the first year since 1982 without an increase. The pandemic has driven down demand for gasoline, diesel, and jet fuel. They came into the year with some ambitious spending plan driven by their investments in shale and offshore discoveries. They originally planned to spend $33 billion in capital and exploration in 2020, but through 3 quarters they have spent just $16.6 billion of that $33 billion they planned on. They're focused on preserving their dividend, and as I said, it is a race against the clock, and the cash flow is being outspent, and you cannot get away from that in perpetuity. They will have to make some changes if the environment does not improve. They hinted they could write down 25 to 30 billion of natural gas assets, including but not limited to that of the Canadian Imperial Oil business that they do own. They've reduced capital expenditures and further potential divestments. Next year, the capital spending is going to be between 16 to 19 billion versus their adjusted plan to spend about $23 billion this year. They once were the most valuable company by market cap, and they have been passed by the wind and solar provider NextEra, ticker symbol NEE. The Permian Basin output is around 401,000 barrels of oil expected in 3Q, and the costs there have dropped 20%. Nasty for Chevron as well. The GAAP loss per share was 12%, but adjusted to positive of 0.11 with the adjusted EPS. Now the total upstream, you can see they don't have the chemicals, but they are vertically integrated with total upstream and total downstream, everything down red everywhere. Michael Worth had said the third quarter results were down from a year ago, primarily due to lower commodity prices and margins resulting from the impact of COVID-19. The world's economy continues to operate below pre-pandemic levels, impacting demand for our products, which are closely linked to economic activity. Doesn't take a rocket scientist to figure that out. Down everywhere across the board. You can see their net production highlights, though. Check that out in the United States were plus 1%, but down 12% internationally. Up 21% for nat gas in the U.S., down internationally down 12% all across the board. And the oil equivalents up 5%. Much like Exxon, Chevron's earnings are forecasted to grow 63%. Everything's expected to grow because this pandemic is not going to stick around forever, and I can't wait for this damn thing to get done and over with. Let's get that vaccine going. Current dividend yield 7.42%, close to Exxon. You have until November 16th in order to get those juicy yields. Get them while they're get them before they're gone. Dividend yield versus the market still higher than the market top 25% at 7.4%. Very nice. But what is not very nice is the negative 80% dividend coverage. The payout ratio expected to be 102%. They're paying that dividend at a loss, just like Exxon, just like most of the companies that are involved in this sector. As you saw, they did turn a slim profit on Q3 cost cutting, making 11 cents per share. So the shares on Friday the 30th did gain 1% to $69.50, but they're still down 40% overall throughout the year. The CFO, Pierre Barber, said the outlook for energy consumption depends on when the world, this country, and others get control of the pandemic and these activities resume. They earned $201 million in Q3 compared to $2.9 billion in the year earlier period. Chevron expects oil and gas to dip to around 550,000 barrels of expected oil in the top U.S. oil field, which is the Permian Basin, and that is down from 565,000 this quarter. They're likely to maintain this level until the economy recovers. They did complete the purchase of Mobil Energy for $13 billion. They now hold a 40% stake in the Leviathan gas field in the Mediterranean, never mind the Gad field there. So that gives them new gas deals in Egypt, Israel, and Qatar. 25% of the Mobil employees will be laid off, though. That may seem cruel, but if you don't do that, the whole company will go under. It's what has to be done. Economics is not called the dismal science for nothing. Many of the companies will have to consolidate with large resilient companies to survive. As I have been saying from the beginning, that many of the smaller companies that are drill only or drill and sell, and they are not as vertically integrated as a Chevron or an Exxon, they will have to merge or consolidate with the large resilient companies in order to survive, and Chevron will be reducing their own workforce 10 to 15%. The CEO, Mike Wirth, said, "Our actions are guided by our long-standing financial priorities to protect the dividend, invest for long-term value, and maintain a strong balance sheet." But as both CEOs have said, they're trying to protect that dividend. I threw this little chart together so we can see the current prices here. $69.50 against $32.62, so over double that. Current dividend per share is $5.16 to $3.48. Current yield, obviously, it's stupidly high, and that's not sustainable in the long run, but I think they have a big enough of a cash cushion that they will be able to sustain this. Now we got to run here. Current earnings per share, the actual, 11 cents, so Exxon is not making any money. They don't have a PE, but this is the current stupidly high PE for Chevron is 631. The forward price to earnings is a little bit more tenable there in the mid-20s. That makes more sense because they are probably expecting a vaccine by then. Current free cash flow payout ratios for the trailing 12 months, not very good. 432% for Exxon versus 306 for Chevron. So the current free cash flow yield using enterprise value, this is something that I have not used a lot, but I want to get better using. So basically free cash flow, that's the cash remaining after they've paid expenses, interest, taxes, long-term investment, and that's money that can be then used to buy back stock, pay dividends. They can use that money for mergers and acquisition. Positive free cash tells us a company is generating more cash than needed to run the business, so they're able to invest in growth opportunities. Free cash flow is such an important metric. There's different variables, but I like to use the free cash flow yield using the enterprise value, which is the entire value of a company, debt, warts, assets, liabilities, everything. They're both currently negative, of course, but CVX is a little bit less negative than Exxon. The 5-year dividend growth rate, though, goes to Exxon at 4.9%. Net margins, negative 7.57% for Chevron, but Exxon is turning a 3.35% net margin right now. The ROE, the return on equity, I like to see that in the teens, but given the current situation, 2.7 to 3.83, Exxon gets that. The interest coverage ratio, both of them are at a loss. They cannot pay. They do not have enough operating income to cover the interest expenses. The free cash from last quarter, $1.823 billion for Chevron versus the negative $4.417 billion for Exxon. I double checked. Those are the numbers I got from Yahoo Finance. So I'm still investing in both of these. Neither is over 3.5% of each of my portfolios, so I can sustain a loss, a significant loss in either of them, but they're not going away. Gas and oil is not going anywhere. It's going to be here. It's just hitting a very rough patch. Both of these companies have been here before. They've been through similar situations with oil. If I did have to pick either one of these, I do have a better feeling about Chevron, as they do have a little bit of a better balance sheet than Exxon, and that is reflected in the share price. The market shares my sentiment. So both of them I am buying for cash flow, and I am keeping my eye on those dividends like a hawk. That's what I do want to see them keep on paying and growing, but they are not going to do it if it means the overall destruction of the company. So if I had to pick one, Chevron gets the green check, but I am confident in both of them that this will eventually all be over soon and things will start getting back to normal. And these both present great, fantastic long-term buying opportunities. We must be patient. Thank you for watching this video, and I will talk to you guys later.